Let me go ahead and share my screen. All right. Let's see. All right. All right. I'm going to have to mute everybody. All right. Y'all going to have to mute yourselves or. Okay. All right. I'm going to mute everybody. Okay. All right. Except, hold on for a second. Hold on, DeAndrea. I'm going to unmute you. DeAndrea?
I'm here.
Okay. Can you see my screen?
Yes, I can see. Yes, I can see that.
Okay. All right. So let's go ahead and get started. All right. But y'all can see my screen okay?
Yes, we can see it okay.
All right. So last week we went over a couple of patterns, and this week we're going to go over market structure. All right, let me see if I could make this screen just a little bit bigger. Hold on for a second. All right. All right. So, all right. So the market structure. One of the most important skills that you need as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You are not going to trade all the markets the same way. You need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior. And if you can master this skill, when you open your chart, you will be able to answer these important questions. What the crowds are doing? Who is in control of the market, buyers or sellers? What is the right time and place to enter or to exit the market, and when you need to stay away? Through your price action analysis, you will experience 3 types of markets: trending markets, ranging markets, and choppy markets. In this chapter, you will learn how to identify every market and how to trade it. So the first one is going to be trading markets, trending markets. Trending markets are simply categorized by a repeating pattern of higher highs and higher low in an uptrending market, and lower high and lower low in a downtrending market. Let's see the example below. This is an example of an uptrend market. Jay, can you close the door? All right. As you can see in the example above, the market is making series of higher highs and higher lows, which indicate that the market is trending up. You don't need indicators to decide if it's bullish or bearish. Just the visual observation of price action is quite enough to get an idea about the market trend. Let's look at another example of a downtrending market. So this is all easy to see once you open up your charts and stuff like that. They have a saying that says the trend is your friend. So if you know that the trend is up high, keeps going higher and higher, even when it goes down low, right? It's making a higher low. It's not making a lower low. This one would be a lower low, which is the downtrend. The example above shows a bearish market. Well, the example over here, as you can see, there are series of higher lows and lower low, which indicates an obvious downtrend. Trending markets are easy to identify. Don't try to complicate your analysis. Use your brain and see what the market is doing. If it is doing series of higher highs and higher lows, it is simply an uptrend market. Conversely, if it is making series of lower highs and lower low, it is obviously a downtrend market. According to statistics, trends are estimated to occur 30% of the time. So while they are in motion, you got to know how to take advantage of them. To determine whether a market is trending or not, you have to use bigger time frames, such as the 4-hour, the daily, or the weekly time frame. Never try to use smaller time frames to determine the market structure, because in a smaller downtrend, let's say in a chart, it's an uptrending market. In a smaller time frame, it might be going down, but the higher time frame is confirmation of the trend. How to trade trending markets. If you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you will look for a buying opportunity, because you have to trade with the trend. And if the market is bearish, you have to look for a selling opportunity. But the question is, what is the right time to enter a trending market? Trending markets are categorized by two important moves. The first move is called the impulsive move, and the second one is called the retracement move. All right, so let's take a look at the example below. As you can see, the market is making higher highs and higher lows, which indicates a bullish market. If you see this market, you would think of buying. But as you can see, the market is making two different moves. The first move is an impulsive move, and the second one is a pullback or retracement move. So when it's retracing and going down, that's the retracement move. And on this chart, all right, this is how you get to see it. As it's pulling back, it's called a retracement. And then as it's going, making a higher high, that's the impulsive move. All right. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profits at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. If you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Traders who buy an uptrend market at the beginning of a retracement move, they get caught by professional traders, and they don't understand why the market hint their stop loss before moving in the predicted direction. See another example of a bearish trend. All right, so there goes the impulsive move, then the retracement, and another impulsive move, and so on. The illustration above shows a downtrend market. As you can see, the best trading decision is to tell the market at the beginning of an impulsive move. If you try to sell the retracement move, you will be trapped by professional traders and you will lose your trade. Now we know how to identify downtrends and uptrends, and how to differentiate between an impulsive move and a retracement move. This is very important as a price action trader to know. But the most important question is how to identify the beginning of an impulsive move to enter the market in the right time with professional traders and avoid being trapped by the retracement move. To predict the beginning of the impulsive move in a trending market, you have to master drawing support and resistance levels. So what are support and resistance levels and how to draw them on your chart? This is what we will see in the next chapter. All right, by the way, this Saturday, I will be going over support and resistance so that we can draw on it too, and also go over another class that I usually do on Saturdays. Support and resistance. Support and resistance are proving areas where buyers and sellers find some of the equilibrium. They are major turning points in the market. Support and resistance levels are formed when price reverses and change direction. And price will often respect these support and resistance levels. In other words, they tend to contain price movement until, of course, price breaks through them. In trending markets, support and resistance are formed from swing points. In an uptrend, the obvious swing point acts as a support level. And in a downtrend, the old swing point acts as a resistance level. Let's go ahead and see examples right here. Now, when you're doing your charts, it's not going to always be just a straight line, a straight line above and stuff like that. These are different support and resistance levels that you can see, and also use these as a take profit opportunity too. The illustration above shows the previous swing point acts as a support level after the breakout. When the market makes the retracement move, it respects the previous swing point support level, which will represent the beginning of an impulsive move. As you can see, when the market tests the previous swing point support level, it goes up again. By drawing the support level in an uptrend market, we can predict when the next impulsive move will take place. Let's see another example of a downtrending market. Now, when we talk about support and resistance, we're to put it in very beginner terms, support is the floor. Resistance is the ceiling, right? So what we're waiting for as traders is, if it has a resistance level, that means that candles touched that area a couple of times but didn't break through. So when we get to that resistance area, we're sitting there looking if it's going to break. And if it doesn't break, usually it goes back down like a ping pong ball to support. So it keeps going from support, resistance. So think of it as a ping pong ball, right? It goes up, down, until the big move breaks it, right? The illustration above shows how the market respects resistance levels when price approaches the previous swing point. Resistance level. All right. Hold on for a second. The market makes an impulsive move. If you understand how price action acts in a trending market, you will predict with high accuracy when the next impulsive move will begin. Another way to catch the beginning of an impulsive move is by drawing trend lines. This is another technical skill that you have to learn if you want to identify key linear support and resistance levels. Let me explain to you first, what do trend lines mean? Quite often, when the market is on the move, making new swing highs and lows, price will tend to respect a linear level, which is identified as a trend line. Bullish markets will tend to create a linear support level, and bearish markets will form a linear resistance level. How to draw trend lines? To draw a quality trend line, you will need to find at least two minimum swing points and simply connect them with each other. The levels must be clear. Don't try to force a trend line. Don't use smaller time frame to draw trend lines. Use always the 4-hour and the daily time frames to find obvious trend lines. We will try to focus right now on how to draw them in a trending market. Our purpose is to identify the beginning of impulsive moves in a trending market. In the next chapter, I will explain to you in detail how to trade trend lines in combination with our price action trading setups. All right, we take a look at the example below. So we're connecting this line, that high, and then we're going lower, connecting that line, then connecting lower. That's what the linear is. As you can see, the market respects the trend line. And when price approach it, the market reverses and continue in the same direction. When the market moves this way, trend lines help us to anticipate the next impulsive move with the direction of the market. Let's look at another example of an uptrend market. All right. As you can see, the market respects the trend line, and by drawing it the right way, we can easily predict the next movement upward. And this is what we say about trending markets. I think it's clear and simple. Now that I want you to do is open your charts and try to find trending markets. Find previous swing points, support and resistance, and try to find trend lines as well. This exercise will help you understand how trending markets move and how to predict high probability entries in the market. The ranging market. Ranging markets are pretty straightforward. They are often called sideways markets because their neutral nature makes them appear to drift to the right horizontally. When the market makes a series of higher highs and higher lows, we can say the market is trending up. But when it stops making these consecutive peaks, we say that the market is ranging. A ranging market moves in a horizontal form where buyers and sellers just keep knocking price back and forth between the support and the resistance level, which I'm not even going to lie, that's ranging markets is kind of the easiest too. One of the easiest. Yeah, uptrending markets are easy too because you're following the trend. But I like trending markets too because it's like a ping pong. It goes up, down, up, down. And then, as we see in this picture right here, the last candle, it broke through the floor, aka the support level. Okay. The chart above shows a ranging market. As you can see, the price is bouncing between horizontal support and resistance level. The difference between the trending markets and ranging markets is that trending markets tend to move by forming a pattern of higher highs, higher lows in case of an uptrend, and higher low and lower low in case of a downtrend. But ranging markets tend to move horizontally between key support and resistance levels. Your understanding of the difference between the both markets will help you better use the right price action strategies in the right market conditions. Trading ranging markets is completely different from trading trending markets because when the market is ranging, it creates equilibrium. Buyers are equal to sellers, and there is no one in control. This will generally continue until the range structure broke out and a trending condition start to organize. The best buying and selling opportunities occur at key support and resistance level. Let me stop right here for a second. When we look at the resistance level, which is the top, and I called it the ceiling, usually when it gets to that and it respects it, I tend to go ahead and buy a put if we're talking about the stock market because I expect it to go down. Or in crypto, we short it. We buy, we go for a short going down. All right. This will generally continue until the range structure broke out. And okay, the best buying and selling opportunities occur at key support and resistance levels. So that's we buy at support, we sell at resistance. There are three ways to trade ranging markets. I'm not going to go into details because what I want you to get here is the skill to look at your charts and decide whether the market is trending or ranging. In the next chapters, I will go into details and I will give the trading tactics and strategies that you will use to trade trending or ranging markets. If you can't differentiate between ranging markets and trending markets, you will not know how to use these price action strategies. The first way to trade ranging markets is by waiting for price to approach support or resistance. Then you can buy at key support levels and sell at key resistance levels. All right. As you can see, the market is moving horizontally. In this case, the best buying opportunities occur at the support level, and the best selling opportunities occur at the resistance level. The second way of trading ranging markets is by waiting for the breakout from either the support level or the resistance level. When the market is ranging, no one knows what is going to happen. We don't know who is going to be in control of the market. This is why you have to pay attention to the boundaries. But when one of the players decide to take control of the market, we will see a breakout of the support or the resistance level. The breakout means that the ranging period is over and the beginning of a new trend will take place. I got to make sure I keep up with time. Okay. As you can see, the market was trading between support and resistance levels, and suddenly the price broke out of the resistance level. This indicates that the beginning of a trend is likely to happen. So the best way to enter is after the breakout. It's important to remember that range boundaries are often overshot, giving the illusion a breakout is occurring. This can be very deceptive, and it does trap a lot of traders who positioned into the breakout. The third way to trade ranging markets is to wait for a pullback after the breakout of the support or resistance level. The pullback is another chance to join the trend for traders who didn't enter in the breakout. All right. So take a look at this chart. We got the resistance level, we got the support level, and then we have the breakout. All right. Some people, all right, you see that candle that went a little bit over that red line? Some people would have sat there and said, hey, that's the breakout, and got in. But then guess what? They would have lost because then it went back down. So you got to make sure you look at those wicks, those tails. All right. As you can see in the chart above, the market was ranging. Price breaks out of the resistance level to indicate the end of the ranging period and the beginning of a new trend. After the breakout, the market comes back to retest the resistance level that becomes support before it goes up. The pullback is your second chance to join the buyers if you missed the breakout. But pullbacks don't always occur after every breakout. When it occurs, it represents a great opportunity with a good risk to reward ratio. What you have to remember is that a ranging market moves horizontally between the support and resistance level. These are the key levels that you have to focus on. The breakout of support or the resistance level indicates that the ranging period is over. So you have to make sure that the breakout is real to join the new trend safely. If you miss the breakout, wait for the pullback. When it occurs, don't hesitate to enter the market. When you are trading ranging markets, always make sure that the market is worth trading. If you feel like you can't identify the boundaries, like support and resistance, this is a clear indication of a choppy market. In Forex, choppy markets are those who have no clear directions. When you open your chart and you find a lot of noise, you can't even decide if the market is ranging or trending. You have to know that you are watching a choppy market. This type of market can make you feel very emotional and doubt your trading strategies as it starts to drop in performance. The best way to determine if a market is choppy is just by zooming out on the daily chart and taking in the bigger picture. After some training, screen time, and experience, you will easily be able to identify if a market is ranging or is it a choppy market. Here is a good example of a choppy chart that is not worth trading. Now, a lot of people see me always put a box when I'm dealing with a choppy market. I always put a box. And then what I do is I set my alerts on TradingView. I could chart something, let's say last month, and I'll sit there and put an alert on top of the box or underneath the box to tell me when it's coming out. One of my trades today, well, not one of my trades, but one of the charts that I charted let me know today that it got out the box. And I said, took you a long time. It's been a month. I've been waiting for you. So yeah, so that's what I do. Choppy markets, I don't trade. But then you have people that are snipers. They're gonna trade an ending market. I just won't do it. Notice in the chart below, the price action in the highlighted area is very choppy and it is moving sideways in a very small, tight range. This is a sign of a choppy market that you should stay away from. If a market is choppy, in my opinion, it is not worth trading. If you try to trade it, you will give back your profits shortly after big winners because markets often consolidate after making big moves. And guess what, people? We are done for the night. I have some homework for you all. I want you all, if you all are in the Discord, send me a chart putting the support and resistance. That's all I want you to do. I want you to identify support and resistance. Usually support and do it on the 4 hour, but usually with support and resistance, remember, support is going to be like the floor, the ground. The resistance is going to be like the ceiling. And the best way to put those lines on your chart is if it has a couple of touches. Don't put a resistance line if only one candle is touching it. That doesn't mean that it's called resistance. It has to have a couple of candles that are touching it to be resistance. It has to have a couple of candles touching it to be support. And next week, I think what I'm going to do is I'm going to also show you all how I do support and resistance and show y'all a little bit about TradingView. So download TradingView. You can also go to the TradingView website. There is a cost, but then there's also a free. For us to do support and resistance, y'all could use the free version. It doesn't matter. But I want to actually put that into play and do support and resistance with y'all. So I'm going to give y'all your time back and y'all could unmute yourselves and let me go ahead and stop this recording.